stream. Ken Creager from BlackSwan Financial Advisors and a sponsor and organizer of the community at Possibilities Achieved. Again, a community for families with special needs and all those who would like to help them achieve an extraordinary life and just help each other out. So I did an earlier video this morning that got posted. Some people might see this one before they see that one. I just wanted to do a little bit of an update now that the Fed has actually come out with their announcement a couple hours ago. So the banking crisis over the last couple of weeks has really caused an interesting situation where the Fed has injected over $300 billion of liquidity back into the system. They just basically undid the last 4 months of quantitative tightening. Essentially, they went back to quantitative easing, which has a very similar effect to lowering interest rates. So, and then Powell came out and announced, the Fed announced today that they raised the interest rates by 1/4 of a point. So what does this really mean? And what is going to be the ripple effect throughout the economy? One very interesting thing is, like I said, quantitative tightening, which is what they were doing. And if you look at my other video, I have some charts and everything in there. Actually, maybe I can show those again. Let me see if I can find them quickly. Yes. This is the balance sheet of the Fed. Okay. So they were tightening, and then just the last 2 weeks, you see this pretty significant spike there. And so, what's going on here? You can see it even better. But now the Fed actually raised interest rates 1/4 point. So, if you look at that in the economy, that's like they're a little bit of a whipsaw action there. You can see that the Fed is still very serious about fighting inflation. So, they're really in a tight spot and in a no-win situation no matter what happens. I think they were finally getting to the point where they were going to start affecting inflation. I personally, I think it was going to be around for a bit longer than most people think. Everybody was waiting for a Fed pivot, and because that's when stocks do really good. So instead, then are we going to get a pause? And I guess in my opinion that the injection of that $300 billion, this easing, is going to really kind of offset that 1/4 point raising of the interest of the Fed funds rate. So I think the net result is going to kind of be a pause. So again, did the Fed just hike, or did they pause, or did they pivot? I think you have a hike and a pivot, and they kind of cancel each other out, and maybe we have a pause. So anyway, I think it's a time to be a little bit cautious. I would stay totally away from bonds until the Fed actually starts lowering the federal funds rate and interest rates actually start going down, because bond prices and interest rates are inversely related. And as long as interest rates are going up, then the bond prices are going to go down. So bonds are going to be in fact, you're going to lose a lot of money, which is what caused Silicon Valley Bank to fail. So again, Ken Creager from BlackSwan Financial Advisors, the community at Possibilities Achieved. Please join my group and encourage family and friends who want to help those with special needs, employment, education, services, government benefits. If you have anything to share, please join that community. This video is for educational purposes only, and I hope you get something out of it. Just wanted to do an update. Thanks. We'll see you later.